Hey everyone, let's talk about stock splits and how does it affect the investors. Now, if you're new investing, this is probably a topic that might not be very frequent in your conversations or maybe in your daily investing, but maybe a few times in a year you might come across these kind of topics. But here we are. Just want to cover this topic just to let you know some of these basics right here. So now, the first thing that comes into picture is that if there's a stock split and you're not aware of it, it looks like a crash. So like this, in this picture right here is like a huge crash going downwards, and don't get freaked out by it. So this long red candle right here, or huge drop in price action, it's about 50% right here. All right. So if you're new to investing, you could get a heart attack just by looking at these charts right here. All right. So now this is actually what happens here. If you actually look at the news or the bulletin, then you can see, uh, at the date of the stock split. So there's a 2-for-1 stock split right here. All right. So now, of course, if you look at this chart, this is not permanent. It's temporary, and it's also indicated right here. When there's a stock split, you can see there's an indication right here, which is a bubble, like it looks like a little bit like a thunder, all right, but it's like splitting a pie over there, right? So now let's go to the next one, and this is all captured in my screen. It doesn't last long, and at first, if you look at it, you might get freaked out a little bit because now this is a case of a 10-to-1 stock split right here. Now this is just recently, and because I'm doing this video in June, 2 days after this split right here, you can see it's done on June 17th with a 10-for-1 stock split. So what does it mean, 10-for-1 stock split? So at the point of time when the price was hovering around 600, all right, hovering around 600, and that's when it announces the stock split, and it looks like the price just crashed, but actually it was not a crash. So it went all the way 10 times smaller than 600, so it's around 60. All right, so this is just a snapshot for my mobile phone, just right in time that I get to see this event. So of course, 1 or 2 days after that, doesn't take too long. The next day, sorry. See, the next day, the price gets to normalize. It was split adjusted. The price was split adjusted. So it was no longer showing 600 at this price action. It was no longer showing something like a crash just now. So and also you can track this in the chart, and you move your mouse cursor to if you're using trading wheel, that you can find a circle with an S. But if you actually are using Thinkorswim, then you can find a purple circle with a thunderbolt symbol. All right, so that's how to look for splits, and you can see that back in histories. All right, so this is nothing to be afraid of, panic. And then you can see, okay, this is 17th of June. Okay, and this is actually FNO. Like we saw a 2-to-1 split. Just now, what we saw was a huge red candle going all the way down, right? So it's no longer showing that, and it's normalized. The price action. The price has been adjusted, right? So whenever there's a split or dividend, there's a huge price adjustment has to be done in the charts. Dividends are smaller, but splits are usually the largest. At least, 2-for-1 splits, at least by half. You might see the price action just drop like that. But just don't get freaked out, all right? So now, splitting the shares is like splitting a pie. So this is like one pie. If you split that into two, it doesn't change the size. Or you can split it even in 8 pieces. It doesn't even change the size. All right. So now this is how we want to say how it looks like the scenario. Let's say for this company A, right? So now before splitting, it was priced about 1,000 US dollar per share, and that's quite a lot, right? So not many retail investors can buy a lot of shares and if they want to sell a share, they have to sell immediately 1,000 US dollar. And this is not flexible for investors, who wants to actually size the position correctly. And well, let's say it's and usually high price stocks, they are also fundamentally strong stocks. They go up a lot, right, in time. So when they go up a lot in time, then it gets to a point where a lot of retail investors have problems investing into the new investors. Sorry, new investors have problems investing into the stock. It's not because they just couldn't afford it. It's also very bad for position sizing, right? You cannot, let's say if you want to have like 10 stocks in your portfolio, maybe like if the stock is like 10 US dollar per share, maybe you can buy like 50, 60, 66, odd numbers where you can size your portfolio nicely. And suddenly you have one in your radar, very nice, good fundamental stocks, which might take up a huge big part in your portfolio, and you couldn't size it properly to balance the rest in your portfolio, right? So stock split is a solution. It's a solution to actually allow retail investors to actually buy at a lower price so that they could size the portfolio more evenly, I would say. So now, of course, back to here again with 1,000 US dollar per share. Then the outstanding balance, let's say, is 2 million outstanding shares with a market cap. If you multiply these two, then you get a market cap of 2 billion. So then after the split, let's say for instance, after the split, 2-for-1 split, then you get a reduction to 500 US dollar per share. But what becomes double is actually this part becomes double. All right, the outstanding share doubles. Then the only thing that doesn't change is the market cap. So this does not change. All right. So like we actually presented earlier, it's like cutting a pie. You have more pieces, but the size does not change. So now, like I said earlier, it's a solution, and also stock splits. They also introduces more liquid into the stock. When more retail investors are able to afford, that means also there'll be more liquid. More people are able to invest in the stock or buy and sell, and also at the same time it suppresses liquidity. Suppresses volatility. You will have more liquidity. That means you have more willing buyers and more willing sellers. All right, so that suppresses volatility and also reduces the spreads also as well. Right. So now let's go back to a bit of history right here. The most interesting one we always see in the history was Apple, and Apple, it has many splits because it was very bullish, right? So stock splits are generally bullish. All right. So and here's what we see. So stock splits, let's say Apple has gone up quite a lot, right? So we'll be able to see some of the history of Apple's price action over a long period of time. So they were around 41 years already listed in the markets. So it was listed about 1980, all right, December 12, 1980. It was actually IPO, initial public offering, around 22 per share, and it has actually split 5 times since the IPO. So now they have adjusted the initial list price. They have adjusted down to 10 cents. All right. So for new, beginning for beginners like new investors, when you look at the stock chart and then you see Apple stock chart right here, then when you look at the IPO date here, then you might find that the price is very low. All right, so you might find it to be around like 13 cents at a time. And now this 13 cents is not where they were public listed at 13 cents per share. All right, so this is because every time there's a stock split, they have to readjust the entire chart, and this affects the IPO price becomes lower and lower every time it splits. The stock splits or dividend, or dividend payouts. There's dividend payouts. Then the whole stock price has to be readjusted, and this affects the initial prices as well, offering price. So let's look at the history, how it looks like. All right. So over the past 41 years, Apple has actually gained around. I think the text is too small right here. So we actually measured from this point to up to this point. All right, all the way up to that point, it's about 100,000% gains. All right, so that means wow, that's quite a lot. So it's more than like well 10,000%. No, more than 1,000. 1,000. Let's see. Let's make a calculation here. So yeah, it's around 1,000 times gains. So if you would have invested about 10,000 USD right here. All right, let's multiply that with 1,000 after 41 years. So I'm pressing on my calculator right here. Okay, let's see. So I'm pretty bad at maths now. 10,000 USD times 1,000 times. So it's like one. So it's about after 41 years, you arrive to 10 million, right? 10 million. So that's a lot of zeros behind, right? So okay, because you see it's quite exponential right here, and just a bit of remark. So is stock split adjusted and dividend price adjusted? So it's now priced at 13, 13 US dollar per share. Okay, 13 cents per share. It can be seen in the chart. All right, so but of course right now you can see Apple is about 130. So it is not that it could be thousands over, right, per share. It is not stocks. There's no split done. So you can see that's quite exponential. You see the price goes up. So this, I mean, in this, if you compare Apple against its competitor, it has the highest margin. The second competitor is about half. The margin is like half of its net margin, right? Half of Apple's net margin. So this is like a huge dominant company in its own right. Okay, so that's a bit okay. That's a magnified because it's too small right here in this area. You couldn't see that, so I actually made a cutout. And this is the IPO date, the start. Then it went bit down, upwards, down, upwards, down. So, but of course, those gyrations, it went all the way up to today. All right. So, yep, that's about it. And I would say thank you for your time. Happy trading. This is Striker X here, signing out.